My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to America. Other people make friends, just trying to make some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Today was day one of the Don't Fight the Fed sell-off, but it's also day two of the Santa Claus rally. The result, lots of cheap stocks participated in the Santa Claus rally, but the more expensive ones got scrooged, with the Dow ultimately dipping 30 points, S&P declining 0.87%, NASDAQ nosediving 0.247%. Get used to it. This may be the new pattern. Like many people my age, I cut my teeth on Wall Street Week. That was a show run by the late, great Lou Rukeyser. Every Friday night on PBS, he'd surround himself with some of the best minds in the business. There were so many good people who'd come on that show. It was practically overwhelmed with insights, even if you didn't like Lou's corny jokes. I took down copious notes every Friday. Often found myself thinking, oh, man, I hope one day I could be a panelist. I never was. But how could you not want to be one? One of my favorite people on the show, a regular, was Marty Zweig, quiet titan who'd done more work about markets and histories than anyone I'd ever listened to. Still, he had simple precepts, including two that I considered getting tattooed on my arms when I got in the business. The left, don't fight the Fed. And the right, don't fight the tape. And that's why I've gotten, and I must get more negative here. Thank you, Marty Zweig. Look, I've been pretty bullish for a pretty long run, right? I still like a ton of stocks. But before Jay Powell pivoted and decided that interest rates had to go higher, I liked tons of stocks, not a ton, but tons, including the ones with amazing growth rates that traded high price-to-sales multiples. I loved them. I damn the earnings, full speed ahead. Back in the days, Zweig spent a tremendous amount of time talking about the interplay between the Fed and liquidity and the stock market. You can spend a lot of time trying to understand this stuff, but if you're managing money, it's very simple. There are fewer stocks that go up when the Fed's tightening, and many more that go up when the Fed's easing. That's kind of all you need to know. And while you don't want to fight the tape, especially since historically we tend to have a Santa Claus rally right about now, you also never want to fight the Fed. You simply can't let the stock market like the stock market as much as you did a month ago, even though it was higher before Powell pivoted. That's the nature of the market beast. So what doesn't work in a world where the Federal Reserve is tightening? Now, you think the big losers would be the cyclicals, right? The companies that need a strong economy, like the industrials. Raise rates, cooled, right? Historically, though, the cyclicals do quite well in the early stages of rate hike. Doesn't really slow things down. They're still doing great business. You have to be nimble, though. There will come a time, an eventual time, where a rate hike will happen that's too far, where the tape turns against the industrials, too. But that can take years, and we're certainly not there yet. We haven't even started. What really gets hammered when the Fed starts tightening are the companies with no earnings, which is why I've been focused on them for you. I can go on and on about why these stocks just aren't worth as much in a world with raging inflation. But what matters here is that big pools of capital often act by rote. They get a playbook, and they stick to it. Now, I want you to imagine that you're in the office of a money manager, smart one. She's got a desk with drawers. Top one on the left, okay, how about that? Has an envelope, and it says, do not open unless the Federal Reserve is about to raise rates. When the time comes to open the drawer and rip the envelope up, what pops out? A slip of paper. And on that paper it says, sell the most expensive stocks in the market. That's it. They're done. That's what they do. Yeah, it's like that. Now, I am sure some of you want to say, but how about this tech stock or that tech stock? Aren't they worth saving? Now, look, I've been thinking about this because I've been working on a special daily segment for the Investment Club where we'll go over changes we're going to make from the charitable trust in a battle head-to-head on them. For months, we've been talking about cutting back on any single stock that's sold at a high price-to-sales multiple unless they happen to have big earnings. If they do, they can be kept, although we sold one today. It wasn't a tech, though, and it was just a remnant, not necessarily representative. But it was a high multiple on earnings. But let's say they don't have big earnings. Then you can't afford to fight the Fed on this at all. If you got a tech stock that trades at 30 times sales, which is what I've been representing to you, a lot of them are, when the average stock sells for 20 times earnings, that tech stock's now in trouble, even if the underlying company is doing well. When the Fed is easy, when it's got rates low, I like that, rates low, Wall Street's happy to pay up for these high-flying price-to-sales stocks. But once we start worrying about rate hikes, once the Fed's no longer your friend, then the market gets a lot tougher on the whole group. Before they could rally on strong numbers, now they need spectacular numbers just to stay in place. And heaven help a great company like Adobe that sells for 40 times earnings if it misses the so-called whisper, the estimates that the Wall Street card sharps are really looking for. We'll speak to Adobe later on the show, and you know I like that situation very much. I find the stock intriguing here after this decline. It's not one of those price-to-sales stories, it's price-to-earnings. But let's wait to hear from them directly, because it's a lot harder to buy this kind of software stock on weakness than it was a month ago. Next group that tends to get blasted when the Fed starts citing housing. I happen to think that the home builders are terrific. Their business is the best it's been in years. However, I'm beginning to feel like I'm overstating my welcome. Lennar's number wasn't that great today, which is why we don't own any housing-related stocks for the Charitable Trust. I always thought this moment would come. It's here. I have enough pain. Thank you very much. Finally, you also have to be careful with high multiple retail stocks. There will be whispers that Omicron strain will cut back mall shopping. You're already starting to hear it, right? Those sirens of selling were easy to ignore before the Fed started tightening. But now we're in a glass-half-empty market. All that said, while the universe of potential winners has gotten smaller, there's still tons of groups that work. Pretty much any financial can win, though some are better than others. Morgan Stanley, Wells Fargo, owned by the Charitable Trust. I like Wells on next year's expected rate hikes, but I don't like it on a potentially tougher regulatory environment. We just bought more Morgan Stanley for the trust in the last downturn, because it has no real credit risk. It's a gigantic fee generation machine, strong leadership, consistent growth, no controversy, just money making. Remember, we don't want to be clever at this stage of the game. Simple's fine. Finally, I really like the consumer staples here, even if it's hard to find good ones. Maybe it doesn't matter. Hey, look, the other day I told you can go out and buy Clorox. Clorox is not doing that well, but it didn't matter. It's going to go higher. Just, that's what happens. Again, that's the envelope. Sell high-growth stocks, sell expensive stocks. The other envelope should say buy Clorox. By the way, just so you know, we can also buy a bunch of other stocks in the same cohort. I like Eli Lilly. Now, I pounded the table last week's club meeting on Eli Lilly. I think it's great. I am not backing away, even though the stock has risen tremendously, including 4 today and 25 yesterday. It doesn't make sense to sell it even at $279. It was up $3 and change. I have no idea if Jay Powell will actually throw us into recessions. So many hedge fund managers seem to be demanding. If anything, I think it might be the opposite. He could whip inflation quickly, and we'll have to swap back into the stocks that we sold. But we'll be doing it at lower levels. The bottom line is that my opinion doesn't matter here. Wall Street has a playbook, and you'll be punished for trying to go against it, which is why you don't fight the Fed and you don't fight the tape.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.